Yesterday, the Indian stock market put on one heck of a show. It was a spectacular last-minute surge that had a lot of people cheering. But as the dust settled and the global markets started telling a very, very different story, a pretty chilling question popped up. So let's get into it.
Was that rally a golden opportunity to buy the dip, a real sign of strength under the surface? Or was it a perfectly laid trap, just designed to lure in hopeful investors right before the floor gives way? That's the big question we're going to tackle right now. Okay, so our investigation here starts in the most suspicious window of the day, those final 30 minutes of the Sensex expiry. See, for most of the day, the market was just kind of going sideways, not really making up its mind. And then, all of a sudden, something just snapped. Now, just look at this chart for a second. What's absolutely wild is how vertical that move was. The entire day's gain, plus some, literally just appeared out of thin air in the last few moments. This wasn't some gradual, healthy climb. This was a rocket launch, and it had zero fundamental fuel. This was an anomaly, plain and simple, and it practically screams for an explanation.
Think about it. A 900-point jump on the Sensex, 400 points on the Nifty. Moves like that are supposed to happen because of huge policy news or some major global event. But yesterday, nothing. The real catalyst wasn't a fact. It was a rumor.
So to really understand this trap, we basically need to do an autopsy on the lie that caused all this. And this wasn't just some random piece of gossip. Oh no, this was a strategically timed piece of old news, brought back from the dead to do the most damage at the market's most vulnerable point. And this timeline, it lays out the whole deception perfectly. Just look at the sequence of events. The original report was already denied, right? But then, around 2:30 p.m. our time, a totally separate report recycled a statement that was months old. The timing? It couldn't have been more perfect, or more suspicious. Happening right during the Sensex expiry settlement. And only after our markets closed for the day did the final clarification come out, confirming it was all based on old news.
So here's the bottom line. The market rallied on this hope of a big ceasefire, a piece of news that would change everything. But the reality was that the news was a ghost. It was a statement from a totally different time, a different geopolitical context, before the current war even started. It was, for all intents and purposes, weaponized fake news. But here's maybe the biggest red flag of all. If this ceasefire news was real, it wouldn't just be an India story, right? It would be a huge global story. Markets all over the world should have been celebrating. But they weren't. As our market closed on a high, the rest of the world was sending a completely different signal. First, let's look at the U.S. markets. The Dow Jones fell, and it fell sharply, down over 1.6%. That's not a celebration. That is a clear risk-off signal, where the big money sells their assets and runs for safety. It's the exact opposite of what our market was doing. The second alarm bell? The oil market. Brent crude actually spiked to $84 a barrel. Let's be really clear here. A real ceasefire would make oil prices fall, not rise. The spike tells us that global traders saw more risk on the horizon, not less. And for a country like India that imports so much oil, that's a direct hit to our economy. And finally, the VIX, what they call Wall Street's fear index, it jumped a massive 12%. When the VIX jumps like that, it means big-time investors are paying extra for protection because they think the market is about to get really choppy. So while our market was euphoric over a rumor, the global smart money was clearly running for the exits. So this brings us to the million-dollar question. If this rally was a trap, who set it? And more importantly, who fell for it? Well, the data from yesterday, both in cash and derivatives, gives us a crystal clear answer. We just have to follow the money. The data here really paints a stark picture of who was on which side of this trade. Just look at the FIIs, the foreign institutional investors. They were massive net sellers, dumping over 3,700 crores worth of stock right into that rally. And if you look at their futures positions, you'll see they are overwhelmingly bearish, 85.5% short. So who was on the other side, buying all this? Our own domestic institutions and retail investors. So what does this all really mean? It means our market is incredibly fragile right now. It shows that when the fundamentals are already strained, the market is super susceptible to manipulation, to these huge swings driven by whispers and lies. And that, my friends, is a dangerous environment for anyone who's unprepared. All right, so that's the analysis of what went down. Now let's get to the most important part. What happens next, and how do you get your portfolio ready for the likely fallout? Because we are facing an almost certain gap down opening. Here's the game plan.
So let's talk strategy. The market is probably going to open sharply lower, somewhere around the 24,540 mark on the Nifty. I want you to think of the 24,500 level as the first critical line of defense for the bulls. If that level breaks, it's a signal of more weakness, and we could easily see a slide down to 24,300. On the flip side, any attempt to rally is going to face heavy selling pressure, first at 24,900, and then an even bigger wall of resistance up around 25,000.
So what could change things? Well, the bull case is pretty slim. It would require the market to hold that 24,500 support and for a real positive trigger to show up, like a sudden drop in oil prices or some genuinely good news globally. The bear case, on the other hand, is basically just a continuation of reality. If that support breaks and FIIs keep selling into global weakness, the downtrend is just going to accelerate.
Here's the most crucial point. Your entire focus should be on the first hour of trading. Does the market immediately try to bounce from that 24,500 zone, or do the sellers just pile on and confirm the weakness? The price action in those first 60 minutes is going to set the tone for the rest of the day, and maybe even the rest of the week. And that really brings us to the final thought here. Yesterday's trap was a really powerful reminder that in these uncertain times, the market is a battlefield of information and, well, misinformation. It really forces us to ask ourselves, are we just reacting to headlines, or are we investing based on a solid, reality-checked strategy?
As always, please remember this analysis is purely for educational purposes. Given how volatile the market is, please do your own research before making any decisions. Now, I'm genuinely curious to know what you all think. Was this a deliberate trap or just a case of market irrationality? Let me know down in the comments. And if you found this breakdown valuable, don't forget to hit that like button and subscribe for more deep dives. Thanks for watching.